In corporate accounting, the cash a company physically pays out during a year rarely matches the expense it reports on its income statement. Two common long-term obligations perfectly illustrate this rule: corporate leases and corporate bonds. Legally, renting a piece of specialized heavy machinery is entirely different from issuing debt to investors. But under U.S. GAAP, the accounting framework treats them almost identically. This is driven by a concept called substance over form, the accounting principle that records transactions based on their actual economic impact rather than their legal framing. To measure that economic reality, accountants rely on a single mathematical engine: present value. Present value is a financial calculation that discounts future cash flows back to their exact worth in today's dollars. Mastering these long-term liabilities means executing two precise steps: initial measurement using present value, and subsequent measurement using the effective interest method. Understanding this two-step process allows you to accurately predict how major obligations will behave on a company's balance sheet over their entire life cycle. Before a lease can be measured, accountants must first classify it to determine exactly what kind of obligation the company is taking on. The defining question here is whether the lease agreement transfers substantially all the benefits and risks of ownership to the lessee. To answer that, U.S. GAAP provides a strict 5-part classification test. First, does the lease transfer ownership of the asset to the lessee by the end of the term? Second, does the lease include a bargain purchase option that the lessee is reasonably certain to exercise? Third, is the lease term for 75% or more of the asset's remaining economic life? Fourth, does the present value of the lease payments equal or exceed 90% of the asset's fair value? And fifth, is the leased asset so specialized that it will have no alternative use to the lessor when the lease ends? If the contract meets any single one of these criteria, it is classified as a finance lease. If it meets none of them, it defaults to an operating lease. But notice the structural reality of modern accounting. Regardless of the final classification, both outcomes force the company to recognize a lease liability and a right-of-use asset on the balance sheet. A right-of-use asset is an intangible asset representing the lessee's legal right to occupy or use the item. This dual requirement effectively eliminates the practice of keeping major lease obligations off the books. Once the lease is classified, we have to assign a precise dollar value to the liability. The absolute rule for initial measurement is that the recorded liability strictly equals the present value of the future lease payments, not the simple sum of the nominal cash payments. This text details a scenario where Caudill Inc. enters into a 3-year lease for a machine. The contract requires 3 annual payments of $100,000, and Caudill knows the rate implicit in the lease is 10%. Crucially, the lease allows Caudill to purchase the machine at the end of the term for $15,000, an option they are reasonably certain to exercise. This triggers the second criteria of our test, legally classifying it as a finance lease. We start the calculation by taking the present value of that $100,000 rental annuity. Discounting at the 10% implicit rate over 3 periods, the value is $248,685. We factor in the $15,000 purchase option. Discounting that single future payment back to today adds $11,270. If you sum the nominal cash payments, Caudill will eventually pay $315,000. But the present value engine discounts that total down to a bedrock initial measurement of $259,955. At the commencement date, the company records the journal entry: debits equal credits, establishing both the right-of-use asset and the lease liability at exactly $259,955. By relying on present value, the framework strips away the illusion of future cash and forces the balance sheet to reflect the true economic cost of acquiring the asset today. With the initial liability on the books, we have to look at how it mathematically unwinds year over year. This brings us to the second half of the valuation engine, the effective interest method. Under this method, the annual interest expense is dynamic, changing in proportion to the remaining liability. The core formula states that interest expense equals the liability's beginning carrying amount multiplied by the effective market interest rate. The carrying amount is simply the recorded balance of the liability on the balance sheet at any given time. To prove that this mathematical rule governs multiple types of liabilities, let's look at how it applies to corporate bonds. This table shows the amortization of a corporate bond issued at a premium. The market interest rate is 6%, and the bonds are issued with an initial carrying amount of $1,083,960. Look at the cash interest paid column. The actual cash leaving the company is stubbornly fixed at $80,000 every single year. But to calculate year one's recognized interest expense, we multiply the $1,083,960 carrying amount by the 6% effective rate. That yields only $65,038. The mathematical difference between the $80,000 cash paid out and the $65,038 recognized expense is $14,962. That $14,962 difference represents the premium amortization. It actively reduces the bond's overall carrying amount down to $1,068,998 as the company heads into year two. The effective interest method forces the recognized expense to constantly adapt to the liability's actual remaining scale. This permanently uncouples the reported expense from the actual cash paid to investors. That exact liability reduction sequence applies directly back to leases, both finance and operating. This text shows our original baseline for Cottle Inc. As a finance lease, the initial liability was calculated at $259,955. Consider an alternate scenario. What if Cottle's contract failed the 5-part test and was classified as an operating lease instead? Without the purchase option and relying on a higher 15% incremental borrowing rate, the present value engine generates a different starting liability of $267,774. While both the finance and operating lease liabilities will shrink over time using the effective interest method, their impact on the income statement fractures based entirely on that initial classification. A finance lease aggressively hits the income statement. It separates the interest expense on the liability and the amortization of the right-of-use asset into two distinct line items, often resulting in higher total expenses in the early years. An operating lease shields the income statement. It combines the interest and the asset amortization into a single, predictable periodic lease expense that is reported on a straight-line basis every year. The underlying valuation engine operates exactly the same way in both scenarios. The initial classification gate is what dictates how aggressively the resulting expenses are presented to shareholders. When you look at the entire landscape of corporate obligations, the sheer variety of contracts can appear chaotic on the surface. But under U.S. GAAP, these obligations are engineered to reflect economic reality, purposefully ignoring the superficial timing of when cash changes hands. Regardless of the financial instrument, the initial measurement is always anchored by present value, and the subsequent measurement over the life of the asset is always driven by the effective interest method. Whether a company is unwinding a bond premium or front-loading the costs of a finance lease, mastering this universal mathematical engine turns a complex balance sheet into a highly predictable model.